Hey, of Patrick Findaro here, co-founder at Vetted Biz. Very excited to have on Michael Reeder, who's one of the few CPAs that is strictly focused on franchising, whether it's working with a first-time franchisee that's buying their first location or a multi-unit operator, and even some emerging franchisor concepts. Michael has really carved himself out in the franchise community, working with all sorts of franchise intermediaries, franchise brokers, all different types of advisors in the franchising space, working together also with franchise attorneys. And he's really cemented himself again as one of the leading accountants in the franchise space. And today I'm just excited to have on Michael, who'll give a bit of bio and how he got into the accounting as well as focusing on franchising. And we'll talk a little bit about the importance of having an accountant and what he sees at going through all these FDDs and all this information that he's analyzing on behalf of his clients. So, Michael, thanks so much for joining today.
Hey, Patrick. Thank you so much for having me here.
So, could you tell us a little bit why you got into accounting and then how you made the transition to focus on franchising?
Absolutely. So, as we record this podcast episode today, it's August of 2022. I'm 35 years old. So I now own the CPA firm that hired me out of college. But before all of that, college, right? College. I grew up in Chicago, went to high school in the Chicago area, just like a lot of kids and a lot of high school kids in the Chicago area. The thing to do when it comes to college is go to a Big Ten school, right? So I was, so no exception for me, right? So I went to Indiana University, and I jumped around majors. I was more focused on having a good time with friends and partying than I was about really actually focusing and like locking down in college. So I was a physical therapy major. I was a journalism major. I couldn't really figure out what I wanted to do, and so I finished college back home in the Chicago area. I finished at a local community college, and then ended up at a local university called Northeastern Illinois University. And so it took me 5 years to graduate college for those reasons, like jumping around majors and jumping around schools. And so really, Patrick, I settled on accounting because it was practical, and I needed to pick something because I didn't want to be like, the next Van Wilder taking like 8 or 9 years to graduate college. So that's how I got in. Like, so I that was my, in college, that was literally my thought process of why to go into accounting, because it was practical and I needed to graduate like ASAP.
And were your parents pushing you? I mean, 5 years isn't that bad finishing college. It's not Van Wilder like at the 8-year mark or whatever.
Right.
Were they hard on you to like, hey, get something that's practical, accounting's good?
Yeah, like they were indirectly sending me the message like, hey, you got to graduate, right? But I was putting a lot of pressure on myself. Those out of state years at Indiana, because I lived in Illinois at the time. It's expensive, and so like I was
it's like 4x the cost of someone.
I was aware of the fact that I was spending my parents' money, and I was jumping around majors and stuff like that. So I really put pressure on myself to graduate ASAP, and so I got connected. So I graduated college with a degree in accounting for those reasons. Like that was my thought process in college. Just graduate, get accounting. It's practical. You should be able to find a job in accounting because accounting is needed out there everywhere. So that was that. And then so my dad lost touch with a buddy of his. They went to high school together, and they lost touch for 30 years, and they reconnected in 2000. So I graduated college in 2010. And my dad, right around the same time in 2010, he reconnected with an old buddy of his after losing contact for 30 years. And they reconnected at my cousin's restaurant in the Chicago area. And so my dad's name is Richard, and his friend's name is Ronald. Hey, Ronald, how you doing? Oh, hey, Richard, how you doing? Oh, my everything is good. My son Michael just graduated college. He got a degree in accounting. Ronald says, oh, like that's cool. My brother Barry, he owns a CPA firm out in the suburbs. Like they should connect. So long story short, my dad and Ron exchanged information, and so I got connected to Ron's brother Barry in November of 2010. and we just hit it off. And I started working at Barry's firm. It was Swartz Financial Management at the time, and I self-studied for the CPA exam for those first few years while I was working at Barry's firm. Became a CPA and became a licensed CPA in. I passed the CPA exam in 2012. Got my license in 2013. Became a minority partner in the firm in 2015, and I bought Barry outright in 2019. So here we are today, and so that's how I I now own the CPA firm that hired me out of college. Obviously, we switched the name to Swartz and Reader Advisors, but really, like, what got me into what started to be me creating my niche in the franchise industry as a CPA, it really started in 2014.
Okay.
And so what happened there was we acquired a couple things. First, we acquired a smaller book of business in the area. And in that book of business that we acquired from another CPA firm, from another CPA who was retiring, one of the clients in that book of business was a self-employed franchise consultant. And so that was I'm 27, 28 years old at the time. That was the first time I ever heard of what is a franchise consultant. So this client,
there's got to be like 2,000 plus, and there's like 9 different organizations. It's a pretty sizable market.
Yeah, exactly. And so I didn't really, I've never heard of this before. So I would ask him about what he does in his day to day, how he connects prospective franchisees and vets them for his inventory of franchisors. I thought it was interesting, and he's a great guy. He's a very successful franchise consultant, very knowledgeable, still a client to this day. Great, and I consider him a friend too, and a mentor of mine in the franchise industry. But I had another buddy who, at the same time, he was trying to get out of corporate, and so I told him, I was like, hey, you should look into this thing called franchise consulting. It's pretty cool. And so he did, and he was intrigued by it. So long story short, my friend, in 2015, he quit his corporate job and he became a full-time franchise consultant, and he joined the FBA back then in 2015. So in those early years of networking in the FBA ecosystem, I went down to Orlando in 2015 and met the great people at the FBA. Sabrina, Chris, Wanda, Amanda, Chelsea, just a great team over there. I went down there with my friend, because he was there, and I went with him, and I was, I was just, I'm a CPA in this industry. I think it's interesting. And when people found out that I was a CPA, they started asking me questions about, I got a buyer, and he or she is, they're investing in this brand, and they have questions about what entity should they be, what should their funding strategy be. They have questions about bookkeeping and taxes, and so my buddy was really the first one who he would ask me these questions, and he would say, hey, Mike, do you mind talking to these buyers of mine, these candidates of mine, to see if you can answer their questions, and who knows, maybe you get a client out of it. So I said, sure. So my buddy started referring me his candidates, and I would provide a free, and I still do this to this day, a complimentary CPA consultation call to these buyers, referred to me by my network of franchise consultants, to answer any questions that they have in the context of accounting, tax, entity structure, funding.
Okay. That's like $1,000 of value right there, because if they do an S corp versus just like a different structure, I mean, it could be huge savings or avoid issues on the line.
100%. And so my focus has always been, Patrick, with this process, was just provide that free consultation, that upfront value for free, provide value, provide massive value, to your point, like, the dollar equivalent is a lot. Deep dive into these topics, and then increase the chance that they will want to do business with me once they actually are in business. And so that's been the case. So still doing the same thing, still have a great relationship with the FBA. I've cultivated a relationship with franchise consultants across the country. I've done a lot of independent networking on LinkedIn with franchise consultants all over. So I have a nationwide network of franchise consultants, franchise brokers, that I am a normal part of their process with their candidates.
Yeah, it's huge.
Yeah. And so any questions that, and so it's, I'm providing value to two different parties in that overall equation right there. One, the candidate, because I'm answering their questions that are specific to accounting, tax, funding, entity structure, et cetera, but also the franchise consultant, because the problem that my process is solving, Patrick, is saying, hey, talk to Mike, the CPA with a niche in the franchise industry, is a better alternative than the status quo, which is go talk to your CPA. All right. So a couple things to unpack there. Number one, a lot of these clients, as you know, Patrick, are coming out of corporate. They don't have a CPA. They've just been doing their taxes on TurboTax, because it's a W-2, mortgage interest, simple. I mean, now it's
or it could be like an H&R Block or some other, I don't know what it's called, an advisor, but it's not a CPA that's
right.
helping them. It's an accounting specialist or whatever the title is.
Exactly. And then also, as I'm sure that because you've been in this industry a while too, the CPA, like the average CPA out there is like on that short list of like what are known in the franchise industry is like, they're known as, and I say this very playfully, deal killers. Like I've got a lot of franchise consultants tell me that they've had bad experiences they've had bad experiences with these deal killers, right? Who are deal killers, right? CPAs, financial advisors, spouse, that other family member that has the ear of the person. And hey, you know what? Like there are situations where there are red flags, and like it's probably not a good idea that particular candidate moves forward with that brand for reasons X, Y, or Z. We're not over here aggressively, urging people to buy businesses with no due diligence. Like there are red flags. I'm sure that we'll unpack some of that type of stuff on this podcast. But I'm an entrepreneurial CPA. I am a business owner, right? Like as mentioned, I own the CPA from that hired me out of college, and I'm the advisor to hundreds of other business owners. I love the business ownership life. I love the entrepreneurial life and all that comes with it. The perks and also the challenges. I love the challenge. I love working for myself, and so I'm not trying to talk anyone out of business. I encourage, but CPAs out there, a lot of CPAs tend to tend to be conservative by nature. And when their client approaches them, hey, I'm thinking about buying this business. What do you think? The CPA, a lot of the times, just their default reaction is to be skeptical, to poke holes in it, to ask questions. And next thing you know, the client is just freaked out and they don't want to do it anymore. And
like the whole context, like many CPAs will assume like every candidate could invest in a McDonald's, but McDonald's, has different requirements, net worth, operational expertise. So you can do as good as you are eligible and can qualify into their franchise, but not everyone's can be a McDonald's franchisee or a franchisee of a big brand because of capital constraints or just not being industry experience in that space. So probably a lot of CPAs look and be, I've never heard of this brand, but it is a brand that's a niche in that specific segment, and it's the market leader or it's the fastest growing one. And I guess a lot of people have to pay their CPA extra because they're paying them to educate on the franchising space.
Yeah, good point there. That's a great point. And to your point, like it's not just CPAs. The majority of the market out there, when they hear the word franchise, they think of QSR. They think of KFC, McDonald's, Taco Bell, and that's really the job of the franchise consultant, right? To really educate their candidate on all of the things out there that really franchising has to, like all the industries that it's in, all the varying different levels of investment requirement and ownership model, right? Like owner operator, manager model, semi-passive. I mean, but yeah, like to your point, like CPAs are included in that group of like the entire market that really, when they hear franchise, they automatically think like Dunkin' Donuts, and there's just so much more to it.
And what's like the number one or a couple of concerns that the first call with that prospective franchise buyer who's going through the process, about to sign a franchise agreement, what's like the first one or two things that they ask you about?
Well, they always ask me about entity structure and funding strategy. Okay. So, and that is really what the complimentary consultation calls are focused on the most. I am not a lender. Okay. I am not a funder. I am not a, and I've got great relationships with, the funders out there, the lenders, right? Like, shout out to Fran Fund, Benetrends, Guidant, Tenant, First Financial, all great people over there. I am not in competition with them, but right, I am a great strategist. I'm a great strategist when it comes to someone who's buying a business and a small business, and and getting the certain facts unique to their situation, and then advising them what I think, and then backing it up with reasoning, why they should go a certain way for entity structure, and why they should go a certain way for funding. And so it's important. So the entity structure and funding conversation, those are the questions that I'm always getting asked about the most on the complimentary consultation calls. And so when answering it, it's case by case, right? So I always get context on 3 different buckets for each person that I talk to. Bucket number 1,
Good.
what is their investment level? Bucket number 2, what is their allocation of assets? The investment level of the franchise that they're going to invest in, initial plus 12 months, like the first 12 months. What's their investment level for their particular franchise that they're zoning in on? Bucket number 2, allocation of assets on their personal financial statement. And bucket number 3, household income and expense situation. When I get context on those 3 buckets, then that drives the entity structure and funding conversation. I may talk to one person, and I will come away from it, and my opinion would be they should go LLC with an SBA loan. I might talk to another person, and the takeaway from that is they should go Rob C Corp, completely self-funded. I'm not a big fan most of the time of going Rob C Corp and SBA at the same time. It could make sense, but there's lots of fees there. But the big key is that everything is unique to each candidate's situation, because every candidate they have their own unique combination of investment level, allocation of assets, and household income and expense. And so just because an LLC makes sense for client number 1 doesn't mean that it's going to make sense for client number 2, and vice versa. Like just because client number 2 goes Rob C Corp doesn't mean that it makes sense for candidate number 3 who's going to go S Corp with funded with a home equity line of credit, for example. So it could, like, the entity structure and funding conversation is customized to everyone. Got to get context on those 3 buckets. That is really the meat and potatoes, Patrick, of these complimentary consultation calls that I have with buyers.
And then you throw in the complexity too, that every state's a little different, and industries like healthcare, depending on the state, it could have to be a C Corp, or depending on the industry that the client's investing in. That's another thing, I guess, that will drive the funding and or the entity structuring.
100%. Like if you're going to go into a medical, if you're going to go into a LE mental health or an anodyne pain or a 100% chiropractic, and you're in Texas, you're like, to your point, the corporate practice of medicine laws. The corporate practice of medicine laws are nuanced by state. Every state has different laws, and so, like in Texas, if you're going to own a medical business, then it needs to be a professional corporation or a professional limited liability company that means that the actual operating entity needs to be owned by a licensed medical professional. And if the franchisee is not a licensed medical professional, then they're going to have a 2-entity setup where they've got the operating entity owned by a medical professional that they and the franchisor will work collaboratively to source in their area. That's going to be the main licensed practitioner that's going to run their location, and then a separate company owned by the franchisee that's going to be the signing party to the franchise agreement, and also will really kind of serve as like a management company where the profit will flow through in the 2-entity setup. So 100%, there's all those nuances. Yes.
And surprisingly, like, I have an experience from like 6 years ago where a client was opening up a property management franchise, and for that state and what he was going to be doing, it really should have been an Inc., C Corp, and he already started the entity LLC. He'd already done all these things, and the franchisor didn't tell him, didn't jump in and give any guidance, and he didn't have a CPA. So it's like, spent all this money, wasted all this time, kind of had to unwind everything and start again on the whole structure.
Yeah, exactly. That's not a good situation. Only adds to an already stressful situation, right? Because investing money, even if they're going to, invest and crush it and be ultra successful, it's natural to be anxious when you're investing a lot of money in something and you have to go through a ramp up period where you're seeing more dollars out than dollars in, because you're ramping up the business. And it's not just CPA; it's also, you got to have a good attorney too, because attorneys are more state specific. Depending on your license, you can only practice in certain states. And so, any buyer needs to have a good CPA from day one. And they also have to have a good attorney, because if they had a good attorney as well as a good CPA, then then one of those two, and it most likely would be the attorney when it comes to like state statutes that require this or that. That would have been snuffed out at the beginning, and it would have avoided a situation where they structured as an LLC and now they have to dissolve it and do an Inc. And that's lost money, lost time, and yeah, you got to spend money, and like what are costs that are necessary and what are costs that are unnecessary, and surrounding yourself with a good team of advisors, mainly a good CPA and a good attorney from day one as a business owner. Just no brainer. You got to spend money on that, just because it's going to result in both short-term and long-term savings.
And what do you see like as a red flag where it's like, oh wow, your net worth is $200K and you're investing $400K in this franchise? Do you have like a debt to equity ratio or something, or what do you see as like, hey, that's too levered or that's too much all in on that business?
Yeah, great point, right? Like it's all about diversification, right? You don't want to put all your chips in one basket, all your eggs in one basket.
Yeah.
This is not a clear-cut rule. This is just my personal observation. Just the investment for anyone should not exceed half of their net worth. Anything more than half their net worth, in my opinion, is too aggressive.
And they can, there's a lot of franchises. I mean, for $50K, you could start, and it's going to take probably longer to break even and then like start getting your return on capital. But eventually, you could potentially make the same amount as a $300K retail investment and not go all in and invest so much of your net worth into that asset.
Exactly. Yeah. Like I'm an entrepreneurial CPA, and I love business ownership just like you and the audience, and our network. But I'm also, I'm strategic and I'm practical, and I like to think that I'm not stupid. And so it's that we got to be tactical about it. So I think that that's a good general rule. And again, like you can be aggressive. There's a client of mine, great guy. He invested in multiple brands at once, first time business ownership. He asked me for my opinion. I told him point blank. I said, if I'm you, I would just focus on the one and make that one profitable. And then there will be other opportunities in the future. And he respected my advice. He and that was like when he's already a client. So it was a paid consultation. I gave him my advice. And he went against it. He was more aggressive. And so that's fine. But,
did he just get excited and was like, there's this opportunity with this brand here. I want to get the territory.
Yeah. There was the second, there was a hot territory. There was a hot brand out there, hot startup brand. And territories were selling quick. And so, he wanted to gobble it up. So he took a risk. And so time will tell if he, risk reward, right? Like he's gonna reap the rewards, or there might be some financial issues that he's gonna have to work through if it backfires against him. But I'm gonna do everything I can to help him.
And then at Vetted Biz, we're basically providing data on all different franchises. We have 5,700 franchises. We have average unit volume on like 1,000 or so for 2021, another 1,000 for 2020. I see a big niche though for someone to help these franchise investors, like that's a multi-unit franchisee of like Wingstop and has 5 units. He's very well versed usually in a pro forma and going back and forth with the franchisor. But I do see a niche in the market for someone to help a franchise buyer, first-time franchise buyer with the pro forma, and the franchise broker consultant, as well as the franchise brand. It's a bit like walking on eggshells because they don't want to overpromise and say, you're going to make 100K your second year and then, potentially have a lawsuit down the line. Do you help with the pro forma, or do you have any advice about going about that exercise?
Yeah. So first, we do provide business buyer services over at my firm, Swartz and Reader Advisors. Business buyer services are financial projections, business plans, helping with SBA loan applications, which which it's implied that SBA loan application is going to have some sort of business plan and financial projection element to it. Business valuations if it's a resale, and item 19, item 21, due diligence, item 6, item 7, due diligence. Those financial items of the franchise disclosure document, holding the hand of the franchise buyer, the first time business buyer, and just really articulating this in layman's terms so they understand. Because Patrick, the franchise disclosure document is a pretty intimidating document. It's often more than 200 pages, lots of legal jargon in there, especially when you get to the franchise agreement piece of it. And it can be overwhelming. It is overwhelming. And so just really going to those because I'm the CPA, right? So I'm going to focus on the financial related items of the FDD, right? The item 6, the item 7, the item 19, the item 21, and just go through them doing due diligence on the financial items of the FDD with franchise buyers. Yes, there is definitely opportunity. It is something that my firm provides, and it's only something that I see becoming more and more prevalent, just because it's needed. And to your point, from a liability perspective, franchisor and franchise consultant, have to be careful with what they say, because there could be a lawsuit. If they make if they get if they can, there's making if they make an earning claim, in the eyes of the franchisee. And if things go bad for a franchisee, then they're going to try to, take everyone down with them that they can. Franchisor, franchise consultant, no one's safe. So absolutely,
everyone that they interacted with.
Everyone they interacted with. Yeah. So that's why a third party CPA like me and my team, we provide these services, and we are, and so it's great for the franchise consultants, for the franchisors, to be able to say, oh, we'll talk to Mike. And what's nice about that is it's all they're doing is say, here, talk to Michael Reeder and his firm. He'll provide you a free complimentary session to answer your accounting and tax and financial related questions, Mr. or Mrs. Buyer. And if you want to work with Michael and Swartz and Reeder Advisors, then that's entirely up to you. So there's a nice layer of separation there. So it's not like the franchisor or the franchise consultant are like requiring them to work with me, or like requiring them to work with me on business buyer services, for example.
And do you arm them, or do you participate on the calls with franchisees? Because I've seen with franchisees that, more like private equity firms that are buying like 10, 20 units or even the whole franchise brand, when they're having the validation call with the franchisee, they come prepared with the pro forma, and they have like very pointed questions, and they're not just like asking a list of like more generic questions. And it's more like, hey, this is my financial understanding. Did it take 4 months to break even, or was it faster? When did you start making 5K? From my model, it shows this. Do you help with that kind of franchisee validation process to basically fine tune the assumptions of the pro forma?
Yeah, so I don't get on any live calls with my client and the other franchisees on validation calls, but I do help them with these certain topics, so they go into those calls more prepared.
Okay, great. Yeah, because it seems like that's a big thing that's missing, and it's it also, like, we transcribe a lot of these calls, and then there's different firms, whether it's like a hedge fund or a private equity firm, that wants the transcriptions, and we anonymize the information. But you can see that it's just much shorter, and the current franchisee is much more cooperative with sharing. If the franchisee is more informed and is asking better questions, you'll get better information to then make that investment decision or go with some other franchise opportunity.
Absolutely.
Going through the FDD, you mentioned like 5 or so items. Is there a particular item or a particular metric that every franchisee, regardless of the brand, really should look at? And it's like, hey, this is a red flag if it's like this, or this is a green flag if it's like this.
Yeah, great question. So obviously for emerging, and like this is just more of like a general. I think everyone should look at it. It doesn't necessarily mean a certain thing if it's like, if it goes against like what we're looking for, but. And if it's an emerging brand, then this is going to be tougher to gauge. But I always like to look at the item 21, right? The audited financial statement of the franchisor. Yeah. And I like to look at the correlation between, because they normally provide 2 years of franchisor item 9 of financial statement, audited financial statement of the franchisor. And I like to look at the relationship year over year trending of royalty revenue and franchise fee revenue. Just as a high level look at it, it doesn't, and because obviously I get more like a green flag is in my opinion, a green flag is if royalty revenue is on the upward trajectory, because royalty revenue is the franchisor is collecting royalty revenue from franchisees. Franchisees are paying franchisors to.
They're getting compensated for client service and providing a good product to franchisees.
It means that
and not selling franchises.
Royalty revenue going up to me is a sign. Doesn't necessarily mean all the time. Is a sign that the franchisor system is working. The franchisor system is working at a very high level. If franchise fee revenue really means that the franchisor is selling a lot of territories. All right, and so if franchise, which can be a good thing or a bad thing, if royalty revenue is on the downward slope and at the same time franchise fee revenue is on the upward slope, I would consider that a red flag. My default is that's a red flag. It doesn't mean that it's always a red flag, but my default is like just that little observation could be a hint, could be a sign that the franchisor is more concerned about selling territories than they are about perfecting their model and taking care of their existing franchisees.
That's really well said. I mean, I've seen, it seems like 90% of franchise brands will break that down, royalty revenue versus like franchise fees and vendor rebates if they do that. But some don't. Have you ever asked the brand like, hey, I'm reviewing this for my client. I notice you don't break down royalties and royalty income and franchise fee income. Do you mind breaking that down for me?
100%. Because when we're doing these due diligence, so one of the buyer services that we provide are item 19 and item 21 due diligence, right? So the client pays me and my team to, pretty much go through the item 19 and item 21 and come up with a list of questions that our client prospective franchisee is going to take and ask the franchisor. And so absolutely, like we're pretty much just go through the item 19 and the item 21 and just, a bullet point list. What's this? What's that? Please clarify this. Please expand on this. What's this? What's that?
Yeah.
And then the client, because the client doesn't know what questions to ask. So we go through and we put that bullet point list of questions to ask. So absolutely.
Well said. Michael, any other, as we conclude today's conversation, any last thoughts for prospective franchise buyers before they jump right into entrepreneurship, whether from your own experience share as acquiring a business, doing roll-ups of other accounting practices, or just serving franchisee clients?
Yeah, man. So just, hey, I'm a very pro-business guy. Very pro entrepreneur. It's got, hey, the internal revenue code is written for the self-employed. All right. Meaning that self-employed taxpayers have more benefits as per the tax code than just like your corporate employee out there. And so it's great, but it's not for everyone, and that's okay. It's not for everyone, and that's okay. And so just it's very trendy. It's very sexy to want to be a business owner out there. A lot of people, it's very trendy to be an entrepreneur and stuff like that. And like I said, it's got its positives, but it's also got, it's everything is case by case. And so if you're listening to this,
I like that.
Yeah, like everything, like if you're listening to this, you got to practice self-awareness. You have to really do a deep focus, a deep meditation into like, what do you want? What's your why in life?
Yeah.
And is business ownership and entrepreneurship a way to get there? Or like as Gary Vaynerchuk says, like, maybe someone is like not a great business owner, but they're like a great like number 15 at Amazon, and there's nothing wrong with that. Business ownership, right? So franchise industry is that third thing that most people that are having that business ownership conversation are not talking about at the dinner table. And that's why franchise consultants provide a great service, because they educate the public on, they educate the market on this. Because what are the two main options, right? Like me and Patrick are, we're buddies, right? And we're having a beer together. And Patrick's telling me, he's like, Mike, I hate my corporate job. And so I'm thinking about business ownership. Like the two things that he's like toggling between the two are, do I start my own business from scratch, or do I purchase an already existing independent business, a business resale, an independent business? Yeah. But what he's not thinking of is franchise, right? And so that's the third option, that when you're thinking business ownership, franchise, there's a whole world. There are new territories, there are resale territories, there's all different types of industries.
Yeah.
There's great funding options. The SBA does not loan to startups, but they do loan to startup franchises. So like that's huge. And but the main thing is that no matter what, it's a big, like, buying a business, whether you're going to start a business from scratch or invest in an independent or go into the franchise industry. And Patrick and I are big advocates of franchise for multiple reasons. No matter what, my message to all you prospective buyers out there is just do not rush the process. It's a very big deal.
Yeah.
No matter what you have on your personal financial statement, it took you a while to get it. Protect your nest egg. Take a risk, but don't throw away the house. And just go through the process with your franchise consultant. Like you're going to be working with a franchise consultant. You're going to be working with the franchise development team at the franchisor. Like because of the way the industry is structured, they're like, those aforementioned people are, like they have there's incentive for you to invest because they're going to receive a commission. And so, but like the good ones do not rush the process. It's this process of doing investigation on different franchises and whether it's a good fit for you or not. And if it is, which one are you going to invest in? It is a big deal, and the process ought to reflect that. So don't rush the process. It's okay to go slow. I understand maybe you got laid off and like you need to do something fast. I understand that everything is circumstantial, but buying a business is a big deal. Do not rush the process. Take your time to do the research and see if it's a right fit. If it is, great. And there's lots of benefits, lots of opportunity, lots of money to be made in the franchise industry. But if you go through it all and at the end of the day you come out and you realize, hey, you know what, business ownership is not right for me, and you're going to go get a job somewhere else at another corporate, just be a W-2 employee somewhere, there's nothing wrong with that either.
Yeah, no, I think that's well said, and I think you kind of act as like a stopgate because you don't have an agency issue as much as like how I see you have the franchise consultant that has great intentions and who's like the buyer rep. If you're buying a house, like he's representing the buyer. Then you have the franchise development who's like the seller broker, and they both want the deal to happen. And you want to help your client. You want him to be happy. You want him to be fulfilled. And if it's a good option, it should go forward. But you don't have the same agency issue where you need this to happen, and you can just say, hey, this is what I see, but this is your decision, and I spotted a couple issues, but everything overall looks good, but this is on you, and you're not getting, you don't need the deal to go forward. So it's good to have that stopgate in the process, because I think with franchising and business ownership in general, there's a lot of glamour involved, and as we know, like 2 years, 3 years, you're putting your head down, you're working, and you're putting in 60 hours plus, and that's it. So if you're not prepared for that, be prepared. I see it for moderate success. If you're not willing to put in big hours up front, like you get what you work, and that's beauty with the US. It's like pretty linear, the amount of work you go in and then what you should be getting, as long as it's the right franchise system that you have the potential to make those earnings.
Right. Like if you want to, like I hear all the time, like they want to own a business, but they don't want to put the work in. They just want, or like, and a big misconception about the franchise industry is that I'm going to, like me as the franchisee, I'm going to stroke a check to the franchisor, and then I'm a business owner and the franchisor is going to do all the work. There are manager models out there, but by the way, those manager models where like that is the closest thing where that's the case, where the franchisor pretty much manages your territory. There's a royalty, the ad spend, and then a management fee on top of it. So how much is really left after that? That's a big,
Yeah, and I think those are like 3% of franchise brands. Like, that makes sense for everyone to engage in that type of option where they can really invest like 5 hours of their time a month, and it still works out.
Yeah, so it's like if the only thing that you want to do is just stroke a check and do nothing, then you should probably just invest in real estate or hook up with your financial advisor and invest in the market or in some syndicated private equity funds, because that's more up, and there's nothing wrong. Again, there's nothing wrong with that. It's just there's a difference between passive and semi-passive. Semi-passive is still like 20 to 30 hours a week at least. Like 20 semi-passive 20 to 30 hours. It's not 60, but it's not 0. and you're really not, and it's going to take, at least to your point, Patrick, it's going to take like 2 or 3 years doing it right to really get to a point where you can do like, 3 to 5 hours a week. But you're going to start out, and even like semi-passive, you might have to do like 60 hours a week for the first 2, and then go to semi-passive in year 3.
These are great questions to validate with the franchisees. Like if the opportunity is being promoted as like semi-passive or even more passive, like double check, understand the hours that they're allocating and how much they're making from allocating less hours.
Right. And like there was like I was about to pull the trigger on 4 territories of one brand. I'm not going to name names on brands, of course, but I was about to pull the trigger on one brand, 4 territories, because a big appeal. I mean, I own a CPA firm, like, so I'm spending my time like managing my CPA firm, and I was going to be, and I was intrigued by being a semi-passive owner here, and I was under the impression, and like the way that it was being presented to me was that I would be able to be semi-passive on day one. But then as I went through validation with both, and that's kind of like how they were positioning it, like just to kind of like get you in. But then as the validation calls and then more real drill down calls with the franchisor, it became apparent that they wanted me to be running my territory for the first couple of years. And then I'd have the opportunity to phase into semi-passive in like year 3. So I couldn't do it because I didn't have the time.
And that could have been okay for you at age like 24, but now your income potential is too high, and the opportunity to just keep investing in what you do, that's the best use of your time. So
100%.
No, I've been there before because I get asked a lot, what franchise would I invest in? And like there needs to be some like non-monetary benefit from like a tax purpose, but maybe your real estate would meet that same criteria. With like depreciation, or I get an operator and I put funding in, I own 25%, he runs the show, and I can provide strategic advice, but there's someone with serious skin in the game, and I'm not working that, I'm really just providing strategic advice. So it's like those type of things I'm open to, as well as investing in like public equity, or say public market franchisors. But yeah, I mean, I'm a big fan of just going all in on something. Like the first couple of years, 60 hours a week, and there are some semi-passive options that make sense. But I think if at all possible, it's great to just go all in and really understand the business for a couple of years at least, and then get the company culture off the ground, and then you could hire a day-to-day manager if you'd like.
100%.
Well, Michael, this has been great. Sorry we went a little over the allotted time. We'll be sure to include your contact information. We'll sync after this on the best contact information, website, email, whatever. And that's great that you offer a free consultation. I imagine the vast majority of those turn into buyer service clients for you, and even CPA clients on the ongoing basis. So we'll be sure to include that information, and anyone that's listening, whether you're a prospective franchise buyer, a current franchisee, even a franchisor that could utilize the services of a CPA, definitely get in contact with Michael, and see if he could be of service for whatever you're seeking.
Absolutely. Patrick, thank you so much for having me on. I really appreciate it. Such a great time. I can talk about this, like Joe Rogan style. We can probably go like 3 or 4 hours, right? So much to talk about.
Exactly. Appreciate it, Mike.
Appreciate you, everyone. Take care.